But what's being left out of that narrative is far more important. This exact playbook has repeatedly undermined currencies throughout history, and this move by the Federal Reserve highlights just how constrained policymakers have become. Today, we're going to break down why this development is a major warning sign, what the Fed's balance sheet is signaling about what comes next, and what all of this could mean for your savings and long-term financial security. Today, we're going to break down why this development is a major warning sign, what the Fed's balance sheet is signaling about what comes next, and what all of this could mean for your savings and long-term financial security. Let's start with how this is being presented. MarketWatch recently reported that roughly $90 billion in Treasury bill purchases by the Federal Reserve are merely technical operations, routine actions designed to ensure stability in short-term funding markets. Around the same time, U.S. Treasury Secretary Scott Bessent pointed out that bond market volatility is now at a 5-year low. The message is clear. Everything is stable, nothing to worry about. But here's the problem. The Federal Reserve is already carrying a balance sheet of approximately $6.5 trillion. You may remember when the Fed announced it would begin quantitative tightening, reducing the massive balance sheet built up during the emergency measures of 2020. At its peak, the balance sheet reached nearly $9 trillion. Since then, it has been reduced by about $2.5 trillion, and then the process stalled. Why? Because the system has become so dependent on debt and liquidity that further reductions triggered stress across financial markets. Liquidity tightened, cracks began to form, and the Fed effectively hit a wall. Now, instead of continuing to unwind, the balance sheet is expanding again, but from a much higher starting point. To put this into perspective, during the 2008 financial crisis, the Fed's balance sheet was under $1 trillion, and today, even after years of tightening, it remains more than 6 times larger. Officials and media outlets are eager to insist this is not quantitative easing. They argue these purchases involve short-term debt, not long-term bonds, and are purely technical in nature. But regardless of terminology, the reality is the same. This is monetary intervention. A financial system that requires ongoing central bank support to remain functional is not stable, and it is not sustainable. Think of it like maxing out a credit card, then opening another card to shift the balance. The problem hasn't been solved, it's simply been delayed, and the longer that cycle continues, the more fragile the situation becomes. That brings us to a much larger issue. Over the next year, approximately $9 trillion in U.S. government debt must be refinanced at today's higher interest rates. On top of that, an estimated $2 trillion in new debt will be added. That's roughly $11 trillion in supply that must find buyers. So who is going to buy it? China has been steadily reducing its holdings of U.S. Treasuries. Japan, historically the largest foreign holder, is seeing capital flow back into domestic markets. Across the board, foreign demand for U.S. debt is declining. Against that backdrop, the Fed's recent $90 billion purchase may seem manageable. But the real concern isn't today's number. It's the scale of what's coming next. If private and foreign buyers step back, the Federal Reserve will be forced to step in. And if it doesn't, interest rates rise sharply, threatening the stability of the entire debt-based system. History shows us how this unfolds. When governments struggle to fund themselves, central banks monetize the debt. More currency units are created, trust in the currency erodes, and purchasing power declines. We've seen this pattern repeatedly, from Weimar Germany to more recent examples like Venezuela. At the same time, institutional investors and central banks move toward assets with limited supply and long-term store of value characteristics. This is one of the reasons physical gold demand remains elevated and why gold prices have continued trending higher over time. Short-term price fluctuations don't change the broader picture. When you zoom out over the past several years, the dollar has lost a significant portion of its purchasing power, while gold has preserved value relative to that decline. If the financial system were truly stable and secure, the Federal Reserve would not be preparing for renewed intervention. That's the key takeaway. So what does this mean for you? First, any apparent market stability is increasingly driven by intervention, not organic strength. That typically leads to more volatility down the road, not less. Second, expanding the supply of currency inevitably dilutes the value of existing dollars. Even if inflation isn't immediately visible, the effects accumulate over time. And third, and most importantly, we are now in an accelerated phase. The Fed was unable to reduce its balance sheet below $6.5 trillion without triggering stress. That leaves policymakers with limited options: tighten further and risk a liquidity crisis, or expand again and fuel inflationary pressures. Neither outcome is particularly favorable for savers. Mainstream narratives may continue to downplay these risks, but the underlying math doesn't change. Monetary intervention on this scale has direct consequences for purchasing power, retirement savings, and long-term financial planning. Even if account balances remain the same numerically, a significant loss in real value can be just as damaging. That's why many individuals and institutions are reassessing their strategies and ensuring they have exposure to assets designed to withstand currency debasement. If you don't yet have a strategy, or you'd like a second opinion, speaking with a qualified analyst can help you better understand your options. Education and preparation are critical during periods of structural change like this. The goal isn't fear, it's clarity. Understanding what's happening allows you to make informed decisions and avoid being caught off guard as conditions evolve. As always, thank you for being here. Stay informed, stay prepared, and I'll see you next time.